2009 was about the risk rally, the reflation trade, which left the U.S. dollar in tatters. But so far in 2010, we've got a very different story going on. Higher yielding currencies are out of favor and the dollar is back in fashion. Let's get more now from David Wu. He's the global head of FX strategy at Barclays in London. David, good morning. Thank you for joining us.
Hello.
David, you had come into the new year thinking that the dollar would rally 5%. You're now saying that that was a conservative estimate and the gains will be bigger. What changed your mind?
I think what changed my mind is that the whole sovereign credit risk premium issue has come to the fore more quickly and more aggressively than we had expected. The whole issue surrounding Greece is starting to spread to the other peripheral European countries like Spain, Portugal, where we've seen basically big sell-off in the stock market this morning and the euro coming under pressure as a result. I think the point here is this. In 2009, the dollar sold off partly because the market was very focusing on the U.S. fiscal situation, which was dire. In 2010, people are realizing actually the U.S. situation is probably going to be improving on the margin, especially after the Massachusetts election. Whereas in Europe, things are going to be getting a lot worse. And I think from that point of view, the dollar is more likely than not to continue to benefit from its safe haven status.
So the dollar looks less bad when you look at how it's compared to the rest of the world.
That's right. I think the point here is that people see very limited scope for further deterioration of the U.S. fiscal position. Not that we see a big, not that we see a lot of improvement ahead, but I think the point here is that the Massachusetts election will suggest that the scope for this administration to actually inject more fiscal stimulus between now and the midterm election is a lot more limited now. Whereas I think the market is definitely turning its sight on Europe, especially given that even the European fiscal problem goes way beyond Greece, because even some country like Germany is going to be running a bigger budget deficit this year than probably Italy. Even France. I mean, France is going to be running a budget deficit bigger than the U.S. this year. So I think all of a sudden people are looking around and see, well, listen, the U.S. fiscal situation is pretty bad, but not much. But elsewhere, things are getting much worse.
Okay, you mentioned Greece. I just want to touch on that for a moment because euro-dollar at an 8-month low. How much pressure exactly is the Greek budget deficit putting on the European currency right now?
I think it's hard to estimate exactly. I would argue probably somewhere between 3 to 5%, since euro sort of peaked around 152 level, back in December last year. So that would have taken euro dollar basically down to, let's say, 145 level. But we're now 138 level. So from that point of view, this is not entirely just a Greek story, the euro recent decline versus the dollar.
And speaking of the euro, we've got the ECB meeting today as well as the Bank of England meeting today. What does the market want to hear from ECB President Jean-Claude Trichet?
I think the market wants to have, the market wants to get some assurance from the, ECB that it's essentially supporting the statement from the EU yesterday about, about the Greeks, basically program. I think the market is really not expecting very much from the ECB today. I think the Bank of England meeting is much more important to the extent that, it's really going to be about whether the Bank of England is going to be stopping the asset purchase program or it's going to continue. And I think, this is going to have ramification that goes way beyond sterling and the UK market, because if they were to stop, I think the market may very well jump to the conclusion that the Fed is more likely to stop in March, and I think that could actually lead to a further selling of risky assets and then probably give the dollar additional boost.
So the BOE meeting as a precursor to what the Fed may say eventually. Okay, David, very quickly here, talk to us about the emerging market currencies, because the real is the world's worst performer this year, down almost 6%. Last year, it was the world's best performing currency.
No, I think, all these EM currencies at the end of the day, they're linked to China. And China has been tightening, and therefore, from that point of view, commodity prices have softened, and a lot of the countries like Australia, for example, or Korea, we expect them to be less aggressive with respect to their hiking cycles now that China is basically going to a tightening mode. So I think generally speaking, investors are very long emerging markets. I would argue that probably the one asset where investors are super long and probably crowded positions are in emerging markets. And this is why probably these assets remain vulnerable in this kind of environment.
We thank you for your time. We've been speaking with David Wu of Barclays in London.